All right, thank you all for hopping on. Today we're going to be going over how to build value with children's policies. I know Jay is on this call and he's pretty good at adding these on when he's in a home, but there's a couple ways to go about it, and I want to show you guys all the different options just because if you're already getting a client when it comes to their, final expense, mortgage protection, Medicare, whatever it is, adding a children or like a grandchild is a really good way to just add on a new client that you could potentially have for life. Whereas, if you get a client in their 60s or 70s, they're probably going to pass away before you do. So that's, you can make sure to add another client that's a long-term client on top of that, and they're very low cost. And everyone loves to, save money for their children or their grandchildren. So it's a good way to just add extra money onto your plate. So let me go ahead and share my screen here. Hadley, do you have any 2 pointers you want to give on selling children's before I get into this?
No, take it away.
Perfect. So I'm going to start with like the most basic way to sell a children's policy. Mutual of Omaha has the best rates I've found. There are a couple companies that you can go with if you don't have Mutual of Omaha. There's Foresters, they have children's policies. Sentinel has children, goes from 0 up, their New Vantage policy. And then also Baltimore A Priorities Whole Life is also from age 0 onward. So Mutual of Omaha has great pricing if you have a pretty low income family and they're like already pushing the budget, paying for their final expense coverage, but maybe they want to get something for their child. Mutual of Omaha is a really great one to go with. So this is just a quote tool that Hadley dropped in the chat if you don't have it, but you can also download the app on your phone and log in, or if you have your agent portal, you can log in and get it that way. But you're just going to click the children's whole life. I'm just going to show you guys a quick example too. And a good way to sell it, you can use my story. I tell everyone they can use my story. I never want to I feel bad saying this because I know my mom's one of my agents, but this is a good story because I was diagnosed with type 1 diabetes when I was 15. So obviously I was not obviously, but I was a very healthy kid prior to that age, and no one would expect, any sort of disease to happen, but it happened when I was 15. So now at that point, I go to try to get an IUL, I go to try to get protected on insurance, and I get declined because I'm insulin dependent, prior to the age that a lot of the underwriting guidelines like. So it's really hard because it's like, well, if my mom would have gotten me a children's policy when I was, 5, 2, whatever, I would have already been locked into a whole life policy and never had to worry about underwriting. I would have been locked in for life. So it's a really good way to tell that story and just say, hey, like, I understand we're not thinking about, your kid passing. That's not what we're here to discuss today. It's really more to help them. If anything were to happen, they have a policy and they don't have to worry about underwriting later on in their life, and they're locked in and you were taking care of them at such a young age. So that's a really good story to tell, just to kind of build value on it, just because it's true. Like, I literally can't get approved for any of the policies I've been applying for. Whereas if I would have already had a children's, I would have already been locked in. So obviously you're just going to put a, state, let's say it's a 5-year-old. And I always try to show them the max first, because obviously it's not very, it's not very expensive, and 50,000 is still like a good number to work with. So for 50,000 for a 5-year-old is $23 a month. Most people are going to think, wow, that's nothing, like no big deal. That's 2 McDonald's meals, like, whereas some people are very tight budget and they might be like, oh, you're already pushing it. So, put it down to 25. Obviously we can make adjustments, but you guys can see here that the cost is so low. And then how you can, build on that is the fact that it is a whole life. They're locked in at that $12 rate for their entire life, if they choose to keep it their entire life. Or if they don't choose to keep it their entire life, they're at least building a very small amount of cash value in there where they can surrender the policy when they turn, 20, 18, whatever, and get a little bit of money out of the policy. And you just protected them during that, those early years in case something were to have happened. So that's a great way to sell it for low income people. Now, if you're talking to people that, have a little bit more leeway in their budget, I say the next tier up would be the Baltimore Life A Priority. So what you're going to do is when you log into your Baltimore Life portal, this is going to be the home page. You're going to go over to this software section. You're going to go over to this Illustrator. And I already had it pulled up over here, so I'm just going to click over here. And then obviously you're going to put in the case information. I was doing it for a 1-year-old, just to kind of show you guys. So 1-year-old whole life, I'm going to go to the simplified whole life here. And what's really cool about this A Priority, if you guys weren't aware, Baltimore Life A Priority is a whole life product that pays dividends. How dividends work is it's based off how the performance of the company does. So instead of just a normal whole life like the Mutual of Omaha one I was just showing you, or just any of the other carriers that we have, whole life cash value builds pretty minimally, especially in the first couple years. Most of them don't build any in the first couple of years. So A Priority is going to pay, on top of the cash value being built, is going to pay dividends based off how the company does. So that's just extra money, kind of like an interest gaining cash value for them. Obviously it's hypothetical because we don't know if the dividends are going to be in a positive, but most of the time it is. So if we want to show just a small 50,000 face amount, you can choose a couple options of how you're going to show the dividends being paid. You can choose a cash where they literally just get a check in the mail every year for however much the dividends were, and your child just gets a check in the mail every year. You can choose accumulation where it's going to build off of the face amount. So like 50,000 will grow based off how the dividends pay out. Or you can do paid up additions where it basically lowers your premium, and you're basically paying up the policy and lowering your premium. For a child in this type of scenario, obviously older people, these options are more common, but for a child, I like to do the cash option because it's like, if you're doing this for your kid, you're kind of like, hey, here's some money for my child. So I choose the cash option.
Scary to make it so you could make the 1-year-old a smoker on that option.
Right? Isn't that, yeah, a little weird.
He's non-smoker.
And then this is another great thing. I always add the accidental death, especially for children, because obviously if a child is going to pass away, it's most likely going to be due to an accident. So I just add that on because it's pretty low cost. So you can add on another extra 50,000. So if they were to pass away due to an accident, they'd have 100,000 to pay for that. If you don't choose it, I'll show you the price difference between the both, but take it off for the first one. And then the guaranteed insurability option is, you can choose it if you'd like. I like it. I usually always click it, but it's completely up to you if you want to choose it or not.
Makes so they can get their kid more coverage down the line without having to prove of insurability.
Exactly. Thank you. Yes. So like for like my example, let's say my mom did get me a whole life policy, or got me this policy when I was 12, and then now and we chose this option. Normally if I would go try to get more coverage, they'd run my MIB report and they'd be like, now she has diabetes, nope, we're not going to accept her. Whereas if I would have chosen this guaranteed option, they wouldn't run my MIB, they would automatically have to give me an extra 50,000 if I chose to. So it is a really good thing to add. But I chose just to show you guys the pricing without the 2 riders. I chose that, but this is a really good way. I just feel like if you're selling A Priority, the great value in it is the dividends, and plus the pricing's insane compared to some of the other carriers. So it's like the added perk of the pricing plus the dividend options is really cool when you show them these illustrations, because you can really show them the numbers behind the dividends. So the first couple of pages is, whatever, no big deal. But this page is really the where you want to kind of get into it with them. The monthly cost, where did that go? The monthly cost is $32 a month. So obviously you can see it's a little bit more than like a $12 or $23 Mutual of Omaha. But you can see these numbers here. So since we chose, so the guaranteed is going to be like, if the dividends never paid out, like let's say Baltimore Life, their stocks were, or their company was not doing well the next 30 years, which obviously never happens, but guaranteed, you're still going to gain some cash value. It's just not going to pay any dividends. Now, the non-guaranteed is like based off of if the dividends were performing and you got, this is based off of the dividends currently. So as you can see, these are in year 1, 2, 3, 4. So in year 5, your child's gonna get $12 paid in cash, $13 paid in cash, 13. So they just get that in the mail. Obviously, it's really small because it's a children's policy. But if you were doing like a 70-year-old and putting more into it, you'll see a lot higher numbers. And then as you can see on this side too, the cash value grows. So they can take policy loans. And then obviously they have a death benefit for $50,000 for their whole life. So it just is a really good added benefit if you're doing a children's policy and they have a little bit more to work with in terms of funds. And then this illustration just kind of gives you more credibility to show them like, these are what the numbers would potentially look like. Any questions about those two? I feel like those two are pretty self-explanatory. Anyone have anything they want to add?
Real quick on those, on the children's whole life, are they able to overfund them?
No.
Like, no, it's just, they just got to pay the minimum. That's it. There's no like, I made extra. Okay.
Yep. So it's not the, we're going to get into the IUL one. That's the one you're thinking of. This one's just a dividend paying whole life. It's just a flat rate, standard underwriting. There's no like minimum or maximum. It's just a flat standard rate.
A quick question too as well. I'm doing the application right now, but dang, what I was about to say. Oh yeah, for the children whole life policies, did they change it over to so you don't have to do a paper application, or do you still have to do a paper application for the children whole life policies for Baltimore Life?
I think you're right. Yeah. Good point.
Yeah, that's why I always do
Good point.
Mutual of Omaha.
Right.
Because I'd be like, hell no, I ain't doing paper application. So
yeah, no, good point. It does require, because I had to do that once. It does require.
Huh?
They're absolutely fillable, and you can download them and submit them into their portal. Like it doesn't make a whole lot of difference on there. Like if you go to your homepage on there.
So if you go to your homepage.
Yeah, and then you go to forms top, and then you're gonna put in the state and everything that you're gonna actually grab on there.
And can you just scan it? Can you just scan it and then import it in there? So you have to send them off to the mail?
Yeah, you don't have to do the mail or any of that stuff. Yeah.
Oh yeah, okay, cool.
Yeah, you can upload it directly on here.
Yeah.
Oh, okay.
Then you find your application on here. So you're a priority.
This says application and underwriting. Let's see if that's it. Oh no, it's just the checklist. Okay. There is a application on here. Let's see.
And for category, I think you might be able to narrow it down by the application.
Bet. Perfect.
And then now and then bam, it's all fillable. It's
all fillable, yeah. So you can be like, you can literally type it like that.
Nice.
Yeah. Okay. And then you download it, and then you go back to your home page.
So yeah, I would just save it obviously with the client's name, and then when you go over here,
secure submit vaultlife.com,
and you can just upload it into here,
just like that.
Good tip, Jay. That was much needed, and thank you for walking us through it, Hadley.
Yeah,
that was
a very easy thing to not just show to people and them all of a sudden not see it in an appointment and be like, oh, forget this, it ain't an option because I'm not going to fumble in front of my client, you know?
Right. Right.
Yeah.
I have a quick question.
Sure.
Kind of piggybacking on what Renee was asking. He asked about overfunding it, and I'm not trying to confuse anybody. If you do the paid up additions, doesn't that allow like an extra bucket, so to say, to overfund it?
It helps build your cash value a little bit better because now there's a little bit more money going back in there for it to build value. But see, like on the whole life side of things, the death benefit's 50K no matter what. So
Yeah.
if they build up $10,000 of value in there and they go and take that 10,000 out because they're 20 years old and they go and get a new car or something, then God forbid died the next day, like
Mhm.
10,000 of cash they took out of there is coming out of the face amount. So the death benefit would be like 40, right? But like
Okay, so the death benefit is not increasing. Like with other whole life policies that you want to try to overfund.
this one is gauged to do that. So this one, if the cash value was left alone, like let's say they died at year 20 here, God forbid, and they got
Mhm.
$55,100, they didn't touch their cash, they died, their beneficiary would literally get a $55,100 check. But if they went and took $3,500 out of that 55,000 there, the beneficiary is only going to get a check for like 51,500.
But that's with all whole life policies.
Yes,
Yeah.
I'm just making that very clear because most people
Okay.
take their
Some people don't explain that properly, and like clients think, oh, I got all this cash value, I can take it out. Like I just had
Right.
happened with one of my clients. Like she's like, well, I guess I don't have a policy anymore. I'm like, well, did you ever take money out? And she's like, I only took like $200, but it was like 20 years ago. I'm like, now the interest is just going boop boop off that. $200, the interest keeps going and go if you don't pay it back, and then at the in 20 years your death benefit is
Right.
a lot
Okay.
of
So
people,
you
they
can
sell-
overfund it, is what I guess I'm trying to ask.
You can add an extra layer of financial value by doing the paid up additions on there, or adding the cash to it, like accumulation.
but you don't overfund it. You're still paying just the 32.
The paid up additions though should allow you to overfund it, is what I'm saying. Like there's usually like scheduled and unscheduled paid up additions.
The paid up additions are through the dividends. Like it's confusing because
Okay.
you're thinking of like just a general paid up additions, but this is like, so here, I think it explains it. And there's a definition page, or is it okay, here it is. Paid up additions, dividends are used to purchase more insurance. So the dividends purchase more insurance, not like you don't pay more.
Okay. So you cannot do a scheduled or unscheduled paid up additions to overfund it
Right.
with this policy.
With this specific one, yes.
Got it.
Yeah.
Perfect.
The only
that's
paid up additions that were through the dividends.
got it. Okay.
Good question though.
Yeah, really good questions, guys. Appreciate that.
Yeah, that'd be crazy otherwise.
Right?
Like, yeah, hey, like the possibility could happen. Just, make sure your agent knows what he's talking about when he selects that option. Like,
You can though with other policies.
With other-
That's what
yeah.
I'm saying. Other carriers, you can add more in there to overfund it.
Absolutely.
Yeah.
Yeah.
Can you hear me?
Yes.
Yeah, you can, a previous company that I work for, they have what's called an op rider, which is an option to
Exactly.
purchase paid up additions. And
Right.
so outside of the premium, the policy owner could add an additional $50 per month, but that $50 would go directly to purchasing paid up additions, which was a way to increase not only the face amount of the policy, but also to help boost the cash value. But what I'm
Exactly.
hearing is that this policy does not offer that option.
Not with how we're illustrating it, yes.
Okay.
This is going to be for your families, you guys. Like, you're not showing this to a wealthy family
No.
that's getting their kids
Exactly.
for college. This is something that, like, hey, you're sitting in a lower middle class or poor
Mhm.
family home, and hey, like, this is an affordable policy. Look what it can do for you. Whereas if someone said, I got $100 a month or $200 a month that I want to put into my kid's vehicle, now we're going to be talking something a little more fancy, like an IUL or another well-structured whole life policy for them. But this is just for your, like, in most homes
Middle, yeah.
you're not going to be selling those complex products.
Right.
You're going to miss out on a lot of sales, confusing poor people that don't even know anything about finances. And you start talking to them about a cash value whole life policy and all it's going to do for them, you're just going to intimidate them and scare them and you're
Yeah.
doing the right business. Whereas if you do that in the right setting, you're going to write some big policies but you have like Mutual of Omaha and Baltimore Life in your arsenal for the average everyday Joe's family that you're sitting with.
Yep.
Perfect. Okay.
Yeah, like I'd say like a good example is like a final expense client is, Baltimore and Mutual of Omaha, mortgage protection, maybe more of an IUL, college funding.
Absolutely.
That's a good way to look at it. Okay.
Yeah, because like mortgage protection is like people are usually still working, they're younger, final expense, they're on fixed incomes, they're usually lower, lower income families. So
Got it.
yeah, obviously we got our first one, Mutual of Omaha, super cheap, straightforward. Here's $7, got my kid a policy, they're locked in. Then we got the Baltimore Life, a little more room in the budget, could, maybe understand a little bit more about the building some value in the dividends and things. But now if we're talking to a wealthier family, or like Hadley said, anyone that can spend over $100, 100 and on, this is the option you want to go with for a child policy. So F&G is, our number one carrier when it comes to these types of products. If you don't have a writing number, don't worry, we can get you one, but don't freak out. I'm just going to show you how to create the illustration and for future reference. So we'll have this recorded, but once you get a writing number, obviously you can utilize it. So you're going to log in sales tools. You're going to go over here to illustrations. Oops, I timed out over here. So let me go back.
That's the writing number you use if you're going to write any deals.
Just steal my login and so obviously illustrations, you're gonna start a new case. I'm just gonna do a child test. Let's say we're doing a 5-year-old. You're gonna go over here to Index Universal Life. Always choose a path setter. Execudex is for like very high net worth people. Everlast doesn't perform as well. Trail Setter, I don't even think everyone has that contract. I don't know why Gage even has one, but Path Setter is going to be the go-to.
I've never seen Trail Setter before.
Yeah, Trail Setter is like, I think only like agency owners. And it's, you don't want it. I mean, it's a good product, but it's not for what we're doing today. So obviously when it's a child, there's going to have to be an owner. So I'm just going to put my name.
Also, I'm only going to butt in just really quickly to mention, I don't know if anybody saw that email today that for juvenile applications that you want to submit through F&G, they have an instant approval now option if you use their new application system, that Wizard, whatever app it is. Similar to like the Execudex that gives you that instant approval where they don't have to have like that full underwriting review or whatever.
Awesome.
It only just came out today. I haven't even gone through everything yet, but
awesome. Thanks for sharing. Yeah, definitely. That's great. So when we're solving for, most of the time we're going to want to do max accumulation and income for our children's. Don't go down in the weeds and trying to figure all these out. Just choose max accumulation and income. Why? Because when you're building for a children's policy, it's usually not catered to the death benefit. We want this to grow cash value for their child. Most people use this for like college funding because it's a good way to put money into a policy where, for one, the IRS can't see the cash value being built. So when you go to get, your student loans and things, it's not going to bump them into a different tax bracket where now you can't even qualify for a student loan if you have all this money built in interest. So it's completely hidden from that. And two, it's a good way to just kind of set them up for whatever they want to use it for. But, I posted on Facebook the other day, I was trying to get people to comment on it. I was like, hey, who's saving money for their children's education? Like drop a me if you are. And, a lot of people are just sort of, if they're not educated, they're like putting it into stocks or they're putting it into a savings account. Is that going to do anything for your kid? It'll help, but it's not going to do the full capabilities of something like this. So this is a really, really great way to grow money for a child to be able to use that for college, a car, whatever the case may be for that future So we're gonna solve for the face amount. When we get into the specified premiums, again, don't get confused with all this stuff. This is a recorded call. You guys can go back to this. So don't get confused right now. And it's okay if you don't understand all this, but I just want to do it so you guys can see it and have a recording so you can go back to it. I always put the mode as monthly, and then we're going to choose the monthly premium. So let's say we have a 5-year-old and the guy's like, yeah, I could put $100 in. That's a good number to base off for children, $100. So monthly premium, put in $100. Pay premium 2. You can either, so there's 2 ways of putting it. You can put A, which is for age, or a Y for year. So I always do age because it's easier for me. So he's 5 years old. Let's say the dad wants to, he's like, you know what, I'm setting this up for my kids, you know, college. He could pay the premium to age, let's say 50. But most of the time I'm setting, like if it's for a normal client, I'm setting it to an age of like 65 of when they're going to start pulling that income. But you can choose whatever this is going to be. Obviously, the longer you pay into it, the more the cash value is going to build. So it's completely up to the client and you to kind of tell them what to do. What would you suggest, Hadley? What do you normally?
So if they're going through school and you just continued to even like pay into this through school, hypothetically, like if you put in till age 24, you would just see when that's like after 24, premiums would stop.
Right.
Whereas if you're educating your kid financially, you wouldn't encourage them to stop their policy, right?
Right.
So maybe perhaps while they're working through college at like age 24 is when they'll take the premium on themselves and mom and dad won't pay for it anymore, and then they can 1035 their cash value into a bigger policy and perhaps start paying for a bigger one when that time comes. But you know, even like you said, if you illustrate it till 50, because just because they're done with college doesn't mean their premium payment should stop.
Yep.
You know, and then I mean, I like to show it to 65 no matter what.
Yeah, that's what I normally do too, but I was like, I don't want to do that.
And because you can show them all the different points of cash value, whether it's
exactly
like 50 or 65, but like, hey, you know, if you had to reset at 24 and you drained all the cash value at it and closed that policy out, and it was time to rewrite a policy where you're ready to put more money into it, then you can talk about it at the time. But yeah, show it till 65.
Yeah, that's what I usually always do. I do age 65. Just because it's better for the illustration too. But yeah, it's completely up to the client. Like obviously you can discuss that with them. But I would recommend.
I make loan fixed rate instead of a variable loan.
Oops. Where?
You scroll down a little bit.
Oh yeah, absolutely.
Yeah.
And then I always choose this option too.
Yep. Minimum non-MEC, you guys, is literally just the 7702 codes. It's a tax violation. If you overfunded one of these policies, you would create a taxable event. You don't want to do that for these families. The easy way is to make sure you don't is just click that box, minimum non-MEC death benefit. MEC just stands for modified endowment contract. That's just a tax violation. Click the box and you don't even have to remember anything I just said.
Yep, just click the box. And then you can choose when they start their income stream. So obviously I always choose 65 because I'm like, hey, if you want to, you know, use this for retirement, it's a good way to kind of set their kid up. So I just keep it at 65, but you could choose a different age. I know I just built an illustration for someone who wanted it to start when the kid was 30. I was like, okay, it's not going to be very much, but we'll show you. So it is obviously based off of case by case, but I usually start at the income at 65 just to show them that. Do you have any tips on that either, Hadley?
No, that's pretty good. I mean, people are going to start living long lives. So like I showed it until 100, like age 100, because like, you know, you don't want to run out of money and Social Security's not around. Like any of us here that are, you know, less than 50 years old, like you may have a concern that Social Security may not be there by the time you're ready to start collecting it, let alone if you're, you know, in your 20s, 30s, or even 40s for that matter. So like you want to provide them a good income stream for the rest of their life, right? Like people are living longer now. It's not uncommon that people are making it to 100, let alone 20, 30, 40 years from now even, you know?
Right.
If you got 25 years on there of income, I just make it to 100. So I mean, if you put 35 years on there, it's just going to show them like, so they're not running out of money when they're 90 type of thing.
Right. I feel that.
Yeah.
This is all just for illustration purposes, you guys.
Yeah.
And then obviously with the face amount for a kid, I always put it in like the minimum. Obviously it's auto going to populate because death benefit option A means it's leaning towards death benefit. So we never want to choose that because we're wanting this to build the most cash value. So that's where option B is more catered to cash value accumulation and less about death benefit. And then when you choose the varies, it basically is like building all this cash value. And then once they turn on the income stream, you choose to change it to cater to the death benefit. So I've used both. But I think for this specific situation, we could do the B to A.
Yep.
So now it's saying death benefit option change year. So now we're just going to say, since I chose the age of 65 for the income stream, we're going to choose to change once we turn on the income to change it to cater to the death benefit. And the reason we're doing that is really just to make sure the policy is built the right way for them in terms of their death benefit leading into the cash value. Because obviously with it has to be within certain thresholds to not hit that like tax 7702. So you just want to, like he was mentioning earlier, the MEC, you don't want that to happen. So this is a good way to kind of ensure that for them. Okay, we got the payment as monthly, paid a premium age 65. Okay, that all looks good. And then I always choose 100% Barclays because that's just overall been performing the best. So when it illustrates, it's going to show a pretty low illustration number, but when you look at the actual numbers in the past years, it is the highest one that has been interest crediting. And this one, whereas any S&P 500 investment allocation will have a cap. So any S&P 500 will have a 12.5% cap on their interest. So like if the S&P 500 went up 15%, they would only gain 12.5. So whereas the Barclays has no cap. So I think that's a huge added benefit because it's like you don't want to have a cap on how much your interest gets credited.
And I will say this, S&P Standard & Poor's 500 is the top 500 businesses in the United States. That list is ever changing. So when you are betting on the S&P, you're betting on the American economy. When you're betting on Barclays, it's a very diversified, broad spectrum of businesses that are across Europe as well as America. So for example, like McDonald's, they're here and over in Europe. You know, Burger King, they're here and in Europe. Like there's going to be certain companies that are here and over there. Those are a lot of common companies that you're going to find in the Barclays, whereas S&P is just American.
Yep.
It's more of a worldly bet when you're going on Barclays, and it's more of an American economy when you're going with S&P. Just to simplify.
And I think we're all kind of scared of the American economy right now. So I think Barclays is a safe option.
They can change this every year on their anniversary too. You can reallocate.
Yep, you can, every year. And that's a good thing to do too, especially with these children's ones, since it could potentially be a client for, 60 plus years. It is nice to know that like we can sit down every so often and change the allocation if we want to. But another great thing about this, I know it's like kind of confusing when you look at it, but Barclays, I'm not going to go into it now. Actually, I'm going to press the illustration and then I'll show you guys it's easier when I show the illustration. It's already going to have the living benefits added and then everything else looks good. So then we're going to go over here and press view and print. It always takes forever, so just bear with this F and G. Okay. So first couple pages are all just summaries. You don't need to go into that stuff with your clients. It's just there in case they ask. This page is just kind of showing like what the illustration below is already going to show. So I don't even go into that page either. This one here, this is where I do show them, because since we put it 100% into the Barclays, this is a good way to look. So look, the minimum look back average for Barclays was 7% minimum. The maximum was 14%. So if we would have put, you know, an allocation, the S&P 500, and it went 14, we wouldn't have gotten 14. But since we did the Barclays, they would have gotten that full 14% credited. The cap you see is 0. Oh, and I guess the S&P is 12 on this one, so apologize, 12%, not 12.5. And then, so this is another great thing, this bonus. After the first year, the first year is 0%. After the first year, they always will get a 1% bonus. Why is that important? Because when you go down to this page here, so this is going to show you examples, since we're only dealing with these numbers on the right-hand side. So look at this year, or in 2007. So these are actual numbers. So it's really good to kind of show them historical numbers, because it gives you credibility, and it shows like this is genuinely what happened this year. So that in 2007, it was down. The Barclays was down 0.5%. So instead of, if their money would have been in stocks in the Barclays and their money going down, their money still goes up 1.25%. Even though it went down, they still got that 1% bonus. Plus, F&G has a minimum of 0.25% minimum. They always add that to no matter what, and that's based on all the numbers. Barclays, S&P, all of them have a 0.25% credit regardless. But that's really cool that even if it performed terribly, you still get 1.25% on the money you put in. Now, and what's really cool too is like you saw this went up 10%. And they got credited this 18.48. Why was it so high? Is because this has a participation rate of 170%. So I know this gets kind of confusing, but like I said, this is recorded, so you guys can go back and listen to it. But 10% is how much the Barclays went up. Theirs went up 18 because you just multiply that number. The 1.7, it would be the participation rate on top of the 10% or 10.28. So they got to participate 170% of their money into that 10%. So it went up above what like 100% across would go. Do you have a better way to explain that? I feel like I did not explain that well, Hadley.
Yeah, so people are like, well, how can you possibly get more than what an entire index is going, right? And so like, when you're taking the average of 1,000 companies, like, you know, maybe they only did get 10% collectively. Whereas if you just put your money in Tesla, it could have gone up profoundly, or it could have gone down profoundly, but you're not going to have the big spikes, and you're not going to have the massive drops usually when they're betting on a collection of businesses like the Barclays, right? So these are companies behind the scenes, when they're taking your money as clients, they're able to buy calls and puts, the option to buy stocks and the option to sell them. So they're able to trade them and make these kind of gains behind the scenes. That way they could even offer you more of a participation than what you could have got in the average of all those businesses, aka the Barclays in this scenario.
Yep.
So it sounds great. People are like, oh, how can that be? Well, that's because they're betting on a collection of businesses, not just one place as well. So they're diversified enough, and they're counting on you keeping this policy active to where they can afford to give you that over time too, because they are earning money with your money, and they're able to offer you something nice for doing so.
Yep. And like I had mentioned earlier, so this is where I was kind of showing, like, obviously the illustration is only going to show like a 5% number, just because we like to under promise, over deliver, not over promise, under deliver. So when we show the illustration, since it is hypothetical, we're going to show like a 5%. But as you can see, geometric average, it was 9.48%. Whereas, you know, the S&P 500 over here was less. So that's why we like the Barclays.
It's actually like illegal for them to illustrate you and give you illustrations that are higher than what like the S&P had actually performed in a certain
Exactly.
time. So they
Yep.
have
Yep, and that's exactly why you can't really coach people to say, "Hey, these are good investments." That's like a taboo word.
Mm-hmm. I know. I'm always like, this is not an investment. This is.
Like I've had clients that will actually will say that, like, "Oh, so this is a good like kind of investment I could put money." I'm like, don't look at it that way. That's not what we're, like that's
Yeah.
not the way you should be looking at it.
The term investment is used loosely, I feel like, because it's like you're investing into your child, but it's like it's not an investment. Like,
don't want to use your E&O insurance.
yeah,
The best line that I really give people is, hey, these illustrations are a promise and a crystal ball to the past, not the future.
yep,
So if what happens in the next 10 years is like the last 10, this is what it would look like. Because you cannot make people guarantees or promises. You do that, you're asking for an E&O case.
I like that.
Okay, my
I actually
crystal
like
ball,
that, yeah.
yeah, I have a crystal ball here to the past, and if the next 10 years duplicates the last, here's what it would look like. If you would have invested 10 years ago, this is what it would have looked like. But if you say, if you invest, this is what it's going to look like, you're asking for a problem. Hey, what's up, Daryl?
Hey, sorry, guys.
You're fine.
You took in the beginning, if I saw this correctly, you took a monthly premium amount, and then it defaulted to 150,000, correct?
It will default to a certain.
Okay, but
Yeah.
then she picked 50,000. So I guess my question is, how do we know that at $100 per month or $1,200 annual premium is not a mech at 50,000? Will it tell us where that point is? Because
Yeah.
what if it were $200 per month? I still need to know at what point won't it mech, correct?
It'll pop up an error. So I don't think we can do it because it's a child, but let's say I did a 30-year-old.
By hitting that button where you don't let it mech, it won't let you illustrate something that will mech.
Yeah, it'll literally pop up an error.
So then you're sort of playing with the face amount then, so where it won't mech.
Exactly. Whereas I apologize for that. That was a little confusing too. You could choose not to put anything in the initial face amount. And if I go over here, it'll auto populate. See, look, policy cannot be illustrated minimum face amount for this product 50. So that's why, but if it was like an adult and you just chose not to put anything in there, it'll auto populate to the one. But since it's a child, we had to put the minimum. But good, that's a very good question, Daryl, because that's very spot on. Like when I'm doing an illustration for a 28-year-old, it's better just to leave it blank. And then when I click the view and print, it's auto going to populate the face amount to show the minimum death benefit, maximum accumulation. Whereas for a child, we have to put a minimum. So it's going to be the 50. Did that answer correctly?
Yeah,
Yes.
and if you put more than that in there, though, like if you were putting $300 a month in there, like if you want to go back to your premium on there, Michaela, and just kind of, let's say we're putting a lot in here for our kids, right?
Yeah.
And even do something absurd like 500 or something.
Yeah, let's do like 500. Because honestly, 500 is the new 100.
It really is. That's for sure. And then, so now we're going to go to like try and see, and now take note of this, guys. It has minimum non-mech death benefit. So it's not going to allow us to illustrate something that's going to create a tax violation for the client here. So if they got $500 for their 5-year-old, then let's show what it would look like. And so now it's going to.
You want me to put nothing in there?
Yeah, we'll put 50 in there to see if it'll even let you. Right? And then it's thinking like $500 for a kid. What's wrong here?
And the cool thing about this, guys, too, like I know we're going through this. I just wanted to do it before a training just so you had one. But the cool thing is if you ever need an illustration, So look at auto went and said, nope, the face amount can't be 50. Now it's 258,000 because that would make, it wouldn't work for a 50,000 to have 500 a month.
That would have been a
Gotcha.
match. So it automatically fixed it now. And see how it's a crazy ass number? 258,134. Like that's very specific. So it didn't matter if you were going to do $50 or $100 in this policy. 50K was the minimum.
Yep.
When you have that non-mech button on there, and you want to put in $500 or $1,000 a month, you're going to have that. But now for you to be able to put in $500 a month for your 5-year-old, you have to have $500,000 of coverage, because they will not let parents use these as a loop to overfund their kids' policies, take advantage of their health, and then just cash them out and steal the money when they're 18. So the parent or the funder has to have twice as much coverage as the kid they're insuring, FYI.
Yep. Good point. Really good point. And Aaron, I saw you had your hand raised, and did we already answer it for you?
No, I was just gonna add to when we were talking about, like, you know, this is not an investment and these are not guarantees. This is a crystal ball into the past. At any point then, are you kind of guiding them and showing them what is the guarantees that they will get?
Yeah. So this is guaranteed. They will gain 0.25% the first year, but since we chose Barclays, guaranteed after the first year, they'll get 1.25%. And that means guaranteed if the market went down, if the Barclays index was down the next 70, 80 years, they'd still gain 1.25%. So obviously, like, I tell them that, but I never go over these numbers because that's never happened, never will happen. So I just tell them that, just to be like, this is a guaranteed no matter what. You can add on a 1% because we chose your Barclays, but this is still going to illustrate that guaranteed column for them. And the non-guaranteed on this right-hand side, the 5.8, it's just telling them current, you know, in the past, whatever, 20 years, I can't remember what number they use, but the past 10, 20 years, it was 5.84% was the average. So we're showing you the past. And that's why he's saying the crystal ball in the past. We don't know what the future is for the Barclays, but guaranteed it, you'll still gain 1.25%.
Got it. I've had some clients that were confused about that. Like,
It's a good thing to show them. Here's your
Yeah.
worst case scenario, and the best is pretty great, you know, and it's probably going to be somewhere in the middle, which is likely 5.84, because the historical here was 9%. But by law, because of illustration purposes, they're not allowed to show you like a higher number than what they have to show you less than what the S&P is actually performing. So they're still showing you a conservative illustration on the far right, but the far left is your worst case scenario guarantee, hence the word in that tabular detail there. Guaranteed assumptions versus non-guaranteed assumptions, right?
And plus, it's a good thing to have a lower number here because this is like assuming a positive arbitrage the next, you know, and obviously there are going to be years that the Barclay could be negative. So it is good to have like a lower number here because it is going to still kind of go in a little, like, obviously it's still compounding, but you don't know if it's going to be 5 every time.
Yeah.
right.
What's up, Daryl?
Just one more question. Can you illustrate this to show a certain level of withdrawals at certain life event periods? For instance, after the college years, taking out for 4 years, then stopping, and then letting it go again to age 65, or maybe even at age 35, taking out $40,000 or $20,000 to buy a home and then paying back. Can you manipulate it so you can show withdrawals at certain points?
On the illustration, no.
You'd have to do your own like calculation and kind of show them, but
Because it's gonna be an unforeseen thing. Like,
Right.
you know, are they really needing 15 or the 20,000? Like, you can give a hypothetical event,
right.
but all of these percentages are going to be gain on their cash value at that point in time. So, like, you know, 5.84% of $70,000 there at age 15, if they went and took out, you know, if they went and took 10,000 out of that, now they're only going to gain 5.84% on 60,000 instead of 71.
Mhm.
So there are two different actually types of like loans and how these work. And I don't want to confuse anybody on this call because that ain't the point of this right now. But just to break that down a little bit, there's two types of loans that are like standard and non-standard. So like if you get a participating loan, which means like if you got $70,000 and you take out $10,000 in one scenario, it's only going to give you cash value on the 60 you have left. Whereas the other scenario is they're still paying you cash values, though you had 71,000, but you took 10 out. But positive arbitrage, you guys, is when your policy pays you more interest than what you accrued that year. So if the fixed loan is 5% on what you borrow and you take out 10,000 bucks, you owe 5% on that $10,000, but the index returned 5.84, you had positive 0.84% arbitrage. Positive arbitrage is when your policy still made you interest more than what you borrowed against.
Yep.
And that's why people want to be their own bank, because I can make a percent or two or 3 or 4. Still borrowing from myself is a heck of a lot better than the loan rate the bank's going to give you.
Yep.
Yeah. I know that was kind of down the rabbit hole, but since you asked, Daryl, I hope that kind of made sense there.
Yeah, because what you have to understand is when you pull from your cash value, the reason it's hidden from the IRS, the reason it is tax-free is because it's still within a life insurance policy. So it's a policy loan. So it's not really your money, it's a loan, which
And you'll
is your
get
money.
down to that in
Tax on a
the
loan.
It's just a loan from your life insurance policy, but it still has an interest rate. So like Hadley was saying, if you pull that 60,000, you don't pay it, or if your interest wasn't crediting, it maybe went negative. Now they're gonna, take that money from your death benefit if you didn't actually like get a positive arbitrage at that point.
Plus, it's always going to be compounded, right? So, I mean, like your account value is still going to stay the same. So, like year after year, that's going to keep going up and up and up. So that same, 5.84, call it, it's
Mhm.
going to give you a higher number. It's going to get tacked on there anyway, while
Yep.
you're still only having that same fixed loan, rate of 5.
Yeah,
So,
you
like,
won't
over,
pay
over
it back.
time.
Yeah, you won't.
But I've had clients ask that too, like, well, when does it actually have to get repaid back? It's like, well, technically, it's like I almost want to say it's not really that question you should have to worry about, but
Right.
since you asked, like, well, it's technically something that would get reduced from your death benefit when that day comes. But like
Right.
at that point, it's not gonna matter.
Right. It's like if you're building the illustration properly, they should have to worry about that, is basically how it goes. But there are agents that don't build it properly, and those clients do have to worry about that.
Yeah.
But we're showing you guys how to build it properly, so you shouldn't have to worry. But this is just a good way to kind of show them. So like, they're paying $500 a month, and if they wanted this for college funding, it's like, hey, when your kid is, okay, let's say they go to college at 19, you have, $118,000 right there of money that you could potentially use for their college. Heck of a lot better, and that's hidden from, the government. So that's a heck of a lot better than going and taking out, a student loan that you had to, pay the next 30 years of your life.
Yeah, totally. And even if you go down to year 20 there, like just kind of as an example, the big bold black numbers there are the 10-year mark. So that's what you would have put into the policy. And then next to what the cash value is over there, 218, so literally like your policy did earn about $100,000 in that time, which
They
is
put in 120, you have 218, like it almost doubled, so it's really great because then you also are thinking, wow, now you have this death benefit for your child too. But let's say, so we're kind of showing them those just for like hypothetical if they used it for college funding. But then what kind of Hadley was saying, and what I do too, is since we built this for up until their age 65, so they are putting into it until they're 65. So they've put in 360,000. Now at that point, which will go down here to this next year, you can see at 61, they no longer are paying into it. Now they have $315,450 a year that they're taking a withdrawal or loan from their policy every year. So that's a huge, like, even just in the first year of withdrawing, you put in 360, even within the first year, you're already in like the positive, or the second year, you're in the positive. So it just kind of shows them that like, this is how you really set your kids up, rather than, oh, let me put it into a savings. Oh, let me put it into stocks that are going to, we don't know how it's going to look, which obviously we all know stocks have their purpose, but like for huge gains and things. But this is a really good way to just have a safe build for your child.
I mean,
Obviously this number is,
$5 a month, you know, that's literally like
Yeah.
$6,000 a year. This was the same of maxing out your IRA.
yep.
Because you can literally put in like $500 a month on those, or $6,000 a year, 6,500 if you're playing catch up.
But yeah, as you can see, these withdrawals or loans are happening every year, and your account value is 8.5 million. But since we're taking out these withdrawals, it's going to take from the surrender value and therefore from the death benefit. But you can just see that even though we're taking these withdrawals, technically the account value is still building. And that's FNG, and you know, some of the companies we're contracted with are the companies that do that, where you can keep your interest crediting even though you're taking withdrawals, and they just take that from your surrender value and your death benefit rather than taking it out of your account value, so that way you can still gain interest off those big numbers.
It's insane.
Hey, I know that's a lot. I know this is kind of a complex, but like I said, it's just a really good way if you're sitting with clients already and you know they have a child, it's a really good way to add something on, because this is a huge value to them. Everyone loves their kids more than they love their house. Like, you're over there selling mortgage protection. Well, how about I sell you something valuable for your child, the person, you know, that you're taking care of and you love. Let's show them how to set them up for success. And you just are bringing more value as an agent. When you find an opportunity like this, don't worry about creating the illustration. Hadley has a link that you can, Hadley, if you can post your Calendly link. He does these and he's really good at training. He will literally sit with you with the client. You can split it 50-50 with him until you get to a point where you're like, now I can do it on my own. But it's a really good way to learn while you're, you know, finding these opportunities. So you can get on with Hadley. He'll help you sell it. You're learning while you're doing it. And then at one point you'll be able to do it on your own. But I think that's a really great way to find the opportunities and still learn while getting paid, because you don't have to, you know, drop the ball and then be all concerned if you're doing it the right way. Hadley will help you with that.
Yeah, I'm gonna put that in here.
And he'll put the link in the chat. Any other questions or any other numbers you guys want to kind of mess around with? Obviously, this is all hypothetical, but if you find a client, you can make adjustments and things. But anyone have anything else they want us to go over? Oh, and I also forgot to mention.
Yeah, just
Oh, go ahead.
to being consistent. I mean, be more consistent. I mean, you're gonna land on things, you know. Even if you have like a bad week, but you know, not really a bad week if you put an activity in. And you put the activity in, it's gonna show. It's gonna show, because I mean, you're gonna land on appointments.
1000%.
Like this dial, you dial, find out what schedule works best for you, and you dial, make it active, make a lot of activity going in. Then you're able to come across the IULs or someone that might need an IUL. You know.
Yes, exactly.
And that's how it works. They can get a lot of referrals too. Like right now, I just closed a deal from someone that hit me up, you know. But it's putting activity in from a client that I helped 2 weeks ago.
Yep.
So,
and that's a great way to call your clients back too. It's like, if you know, you sold them a policy and they put down their child as a beneficiary. Hey, I just wanted to let you know that we also help out with, you know, helping for funding, whatever, if it's a client that they can afford it. But like, you still want to talk to them about like the next time you call them, just bring up that, oh, I remember you put down your child as a beneficiary. Did you have your child set up for, their life insurance? Have you looked into that? Because that's something we can go over. It's a good way to call back your current client base. Most of them have children, and you can try to sell something else on top of it. And even if they don't have the money, you can still sell them a small policy and touch base with them and try to get referrals.
Yeah. Another thing too, what I'll be doing is like when I'm doing the applications, like some people they don't put like their like multiple beneficiaries or contingent beneficiaries. Yeah, put a contingent beneficiary and put their emails down and everything else so you could get a hold of them because people change their phone numbers. But also, like after you do that, give the contingent beneficiary a call or the beneficiary a call, let them know what you just did, right? And then so that means you can ask them if they actually need their your service. And
Absolutely.
most time they don't have it. So and that's what I'll be doing. It works. And
Great.
if not, they're gonna come call you back. Like, let me see what I can do and da 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 da. And
Absolutely.
the appointment.
And you said it as like what Jay said, like you set it up as like, hey, I'm just letting you know that you are the beneficiary on this policy. I wanted to make sure you had my phone number because when that day comes, you can give me a call and I'll help you with the claim process. But I also just wanted to ask if you had this taken care of as well. It's just like you're being like a courtesy, like I'm here to help you, but also, try to get something else.
100%.
But what I was going to mention too, and I didn't want to miss before we get off here, was when you're showing these policies too, you want to definitely mention the living benefits just because it's another added benefit, especially for IULs. Their living benefits are a lot better than some of these term and whole life ones. I think there's a page. Where's it at? Here we go. So living benefits here. So there's a critical illness available until age 70 that they could have up to 500,000 if they get critically ill, chronic 817, terminal 817. So that's a good way to kind of show them that like if they ever get sick, they have some money to work with as well. And this page kind of breaks down the numbers too. So that's just an added benefit on top of all the other benefits of this policy that is included. And a lot of people kind of utilize this as a alternative to like a long-term care policy, because a lot of people are like, I'm gonna spend $2,000 $2,000 a month on a long-term care policy, and then who knows if I even use it. And so this is kind of a good way to bridge that gap.
And those numbers are huge because this was based off of $500 a month for a 1 or a 5-year-old.
Yes,
so
that's
like
huge,
built
but...
yeah, those will get adjusted, but
yeah, normally they're not that big.
yeah.
Okay, I think I got everything. And then obviously we're going to go over the numbers really quick. I know we're kind of going over time here, but last week, pretty low numbers, but I know we're in AEP. So of course we're kind of racking up the health side, which is great. We had 34,800 potential commissions for the life side, and we had 56 Medicare and 1 annuity. So great job, guys. All right, I'll start at number 10. We got Miss Ada, 1 app for 1,100. Pamela M, 1 app for 1,100. Ashley G, 1 app for 1,140. Lauren G, Loguna, 1,140. Marcus D, 1,285. Drew Seaberger, 2 apps for 2,900. Jared Lindsay, 2 apps for 3,500. And just so you guys know, Jared and Drew are staying with us, and they're actually down here running Medicare and mortgage protection leads for Mobile, Alabama. So another travel trip for these two. And you guys are all welcome to do the same if you have any leads down in Mississippi, Alabama, Florida. You can stay with us as well. Mr. J, good work. 3 apps for 486. Beto, 1 app for 6,828. Insane Baltimore Life product right there. And that just shows once you switch from final expense to mortgage protection, that's the type of policies you're going to run into. So if you're still running final expense and you're getting comfortable with it, great, but make sure you try to take the next step up and work into some mortgage protection so you can get a little bit higher premiums. And then we got Miss Mama Sherry, 8 apps, 7,500. Good work. Love seeing her name up there. And these are our Medicare. These are our Medicare enrollments here. Gage at 15. I know a lot of people probably didn't know, but like Gage and I, for the entire month of September, we're running Medicare appointments and just setting ourselves up for AEP. So if you're not running Medicare yet and you're wanting to figure out for next year, that is the way to do it. Because look, we're only like 4 days into AEP and we already have 15 enrollments. So that just shows that when you set yourself up for AEP, now we're already jump starting it. Karina with 7, Lauren G with 7, Anders with 6, Marcel with 5, Billy T with 2, and Natalie D with 2. Good work, guys. VDP, Value Driven Professional of the Week, Miss Mama Sherry, 8 applications. She's been absolutely crushing it. She's still part-time agent, still runs her jazzercise business, and it's just really cool to see that, you know, even as a part-time agent with focused hours, you can sell a lot of insurance. The issue with a lot of us are full-time, but we don't actually manage our time properly. We're not focused during those hours, and we're probably less than part-time compared to Mama Sherry, who's genuinely part-time, but focused, dialing, focused hours, planting seeds, building her funnel, and really working it as a, you know, value-driven professional. And then our value-driven professional for the Medicare side, Mr. Gage P with our 15 enrollments.
I know if it was showing that slide on there.
Oh, it's not?
Yeah, it's still on the Medicare enrollment.
Oh.
There we go.
Whoopsie, sorry about that. I meant to pause, or I meant to stop the recording, and I think I stopped the share. Whoopsie.